I believe it's going to continue to get worse. I believe delinquencies are going to keep getting worse across the board. And so at some point, the banks are going to start seeing a rebound of those prior loan modifications that they're going to have to deal with as a second wave. At the exact same time, you're seeing a worsening in the portfolio that hasn't been modified. So I'm less dogmatic that there's no way in the world this is going to work, but only marginally so, right? But what I've learned through 20 years of looking at the bank data is you can't underestimate the policymaker's ability to change the rules. So if you have problems and you can't deal with the problems, and the way of dealing with the problems is recognized and tracked, we just stop reporting.
Hey everyone, and welcome to another episode of the WTFinance podcast. On this episode, I have the pleasure of welcoming on Bill Moreland of Bankregdata. So, Bill, thanks so much for coming on the podcast there.
Yeah, I appreciate it, Anthony. Looking forward to spending some time with your audience.
Yeah, really interested. We were talking, a couple of weeks ago, and we are trying to organize an interview, and I really found your insights interesting. And on a recent interview you did, I wanted to bring you on and see what you're seeing in sort of the economy and credit and how you're tracking that. So yeah, really interested in hearing your current outlook on what you're seeing in the data at the moment.
Yeah, so we've had successive waves here in the United States of bank crises or mini crises. And a couple years ago in 2023 was going to be the securities available for sale, held to maturity issues with mark to market. And now we're basically kind of trying to dig our way out of some consumer issues and some CRE issues. But if you'll indulge me a bit, I wouldn't mind taking a moment to basically walk through a couple of charts that help frame the discussion, because much of what we're basically dealing with in the US banking system right now is primarily driven by things that happened in 2020 and 2021. So let me go ahead and share my screen. All right. And so what I'm doing is I'm basically pulling over. Hopefully you can see that fairly well. What this is, and so Bankregdata is a service that basically takes call report data from the FDIC, and it's basically quarterly data that captures about 1,100 data elements on U.S. banks. These are U.S. depositories. And so we can do a lot with this data, right? This is going to be total deposits for all U.S. banks in trillions. And what we have down here on the x-axis is starting at 2015 Q1, every quarter moving forward to the most recent data set, which is 25 Q3. So you can see with the yellow line some nice steady growth in the deposits in the U.S. system up until 2019. And then from 2020 Q1 through about 2 years, looking at 22 Q1, we basically see an extra $5.5 trillion of money flow into the U.S. banking system. So this is essentially M2, right? This is money. This is U.S. money. Bank deposits are a big driver of this. And so part of the issue that we see with this is part of a big explanation why everything is 38 to 40% more expensive in the United States, is because we dumped 35 to 36% more money into the banking system. So that's one side of the discussion that's kind of above and beyond the scope of what we're talking about here, but it does go a long way to understanding why things are more expensive. But the bigger fundamental problem is that these are liabilities for banks. These are essentially an extra $5.5 trillion. And if we look at that yellow baseline, that's normal inflation, right? That's normal loan growth, normal deposit growth, that kind of stuff. And we can make a good argument there's about $4.5 trillion excess. So what that presented was a problem for the U.S. banks. And what that means is these are liabilities. And while we weren't paying anything on those deposits during this time frame, banks basically put deposits to work, right? And so how do they do that? How does that turn into an asset? Well, it turns into them buying securities. And that's what this chart shows. We still see the same green. We still see the same 14.5 trillion to 19.93 trillion. But the purple data set basically shows a mirror, right? Almost exactly when the money started flowing in. And this is going to be from the Fed buying $5 trillion of mortgage-backed securities and treasuries, dumps money. This is going to be from PPP loans. This is going to be from the massive deficit spending that took place during this time frame, which is money creation, which is still taking place, by the way. But basically, the purple shows that from 2019 Q4, we had 3.98 trillion, so just under $4 trillion. And then the numbers climbed to 6.26 trillion. So we can see of that extra $4.5–5 trillion, a little over two and a quarter trillion flowed into securities. So I'm going to go ahead and stop sharing. When we talk about why did Silicon Valley Bank happen, that's why. And then you have to layer on top of this, and I'm going to date myself on the audience. I've come to learn that we've raised an entire generation of people in the United States that for the most part, we have a generational divide on what is normal interest rates. If you're 35, 37 years old during this time frame, your frame of reference as an adult is 0% is normal, right? If you're older, and I'm considerably older than that at 57, we kind of view 0% interest rates as broke. That's not normal, right? Interest rates should be 3.5, 4, 5, 6, 7%. They should float depending upon the market economies and the value of money and the risk of money. But basically, the reason I bring this up is when we dumped an extra $5 trillion of money into the system, understand the backdrop was that we had spent 13 years teaching policymakers, bankers, regulators, asset managers, counterparty risk treasurers of big companies that have hundreds of millions of dollars in US banks, right, as their working capital. We taught a lot of those people zero is normal. We'll come back to zero. So buying yields of securities that are yielding 175 to 200 basis points for Silicon Valley Bank, which is what they did, felt like a very normal thing to their management team. So the wave of issues that we had with Silicon Valley Bank and a lot of the bank problems, the mark-to-market losses, was due to the extra money that flowed into the system.
Yeah, really interesting. I guess the challenge as well is the regulatory shift in terms of how the central bank, the regulators were allowing banks to hold sort of government bonds as if it's basically as if they're deposits, as if they're cash. And the challenge that we found, because the trend, I guess, in the past 40 years has been that as you mentioned, their rates come down, yields come down, so it's going to be the value of the bonds are going to go up, or they're going to remain quite consistent. That obviously disconnected during COVID, and that was another issue. That duration risk is what we saw. So it's really a secular shift, as you're saying. So that's something that you think is going to continue shifting from post-COVID. Do you see that going?
Well, yeah. So I'm old enough to remember Dodd-Frank, right? And the mortgage-backed security problem. And people, pounding on tables in Senate hearings saying we're never going to allow mark-to-market losses to create problems and risk in the bank system where the taxpayer has to bail out banks. And so we talked about a lot about the rules changing during that time frame. And the bank said, fine, if you're going to basically make us mark to market all our securities, we're just not going to hold treasuries, right? We're not going to hold mortgage-backed securities because the risk is too high. At that time, the U.S. banking system held about $100 billion of U.S. treasuries. Today, that number is close to 1.5 trillion. So we sit there and we lament China's going to dump their treasuries. Japan's going to dump their treasuries. The U.S. banking system holds way more treasuries than each of those independent parties, right? And so part of that is the devil's bargain that the government made with the banks is we'll allow you to go back to held to maturity. You don't have to market. But it sure would be grand if you could soak up a lot of this excess money. So if we're sitting there saying, if the question is, do we think the U.S. banking system is going to take more exposure to treasuries? Oh, yeah, we're going to take an enormous amount. So if I can, I'm going to go ahead and go back and share, and we're going to segue into essentially the other part of this, which is loan. So this is the same chart, only overlaying loans. And so we can see at the 2019 Q4 time period, there was $10.52 trillion. in the banking system. Then that number skyrocketed about $500 million, but about billion dollars, but about 485 billion of that was the government just creating PPP loans. And ultimately that number was about 800 billion and change. And so understand that first initial wave of loan growth was the government just printing money. And then that money immediately basically went back into deposits, right? So it was just creating upwards of $800 billion over a couple of months, a couple of quarters. But you notice loans shrunk. Banks weren't making loans. Now they're buying securities hand over fist, but you'll notice that we, starting in 21 Q1, we had $10.82 trillion. And then that's when the loan growth started to take off. So there was an echo, right? Is the money was printed and dumped into the system. A lot of banks went out and bought securities lockstep. But the echo of this was about a year and a half, 2 years later, you started to see the significant loan growth. So from 21 Q1 and 10.8 trillion to 23 Q4 and 12.45 trillion, that's basically pushing, 1.6, $1.7 trillion of new money. And note how I've highlighted here $229 billion of new CRE and $293 billion of new card. So basically what this has done is, if you wonder why we have credit card problems and consumer problems and we have CRE problems, understand this is an echo of the massive. So when banks had these excess liabilities known as deposits, they put them to work initially in securities and then echoed that essentially in loans. And so a couple years later is when those loans start to have vintage curve issues. And that's when you basically start to see the credit card and the CRE problems in 24. Just to give you an understanding, that $229 billion of credit card loans is the fastest 11-quarter growth on record. Credit cards of 293 billion was the second fastest 11-quarter growth period. Actually, it shifted one ending in 24 Q1, so it overlaps almost exactly. So during this time frame, we were basically dumping an enormous amount of money into the system. It echoed in CRE, it echoed in commercial real estate. And so we actually wrote an article about this. If we go back to essentially an article that we wrote during this time frame, it's called The Artificial Consumer. And you can see this time frame was over 2 years ago. And what does that mean? Well, I'm a credit collections guy. My background is Wells Fargo, American Express. It's running collection shops. It's running risk shops on the front end for underwriting. And so what we were identifying was, you can go back, and I'm just going to bring up the industry. We're going to take a look at all loan portfolios. We're going to take a look at consumer credit cards first, and we're going to basically look at delinquencies. And so this is what the delinquency rate is in billions of dollars. The percentage is upwards of 3.14. But really what I'm going to show here is what I mean by fake. So if you look at this chart, this is a 10-year chart on credit card delinquencies. Notice how we were going up. And there's a seasonality, a component in this. So I highlight the every fourth data point. And right now what we're on is Q3. So if we go back on this side, 246, 274, 273, 281. So understand there's a bucket of debt servicing that U.S. consumers will fill up with their ability they'll take on more debt to a point where they can service it, and then they'll stop, right? So they'll fill their cup of debt servicing up. That's student loans, that's car payments, that rent or mortgage, and that's credit cards. But then notice how in 2020, when that flood of money came into the system, the delinquencies fell through the floor. Now, on the surface, a lot of viewers may say that's a healthy thing. It's not. So what happened was the 281 went to 206, went to 161. We've never seen delinquency rates at 161. And then you see it snapped back up to being well higher. So there's a couple things here. One, we were getting long in the credit cycle long in the tooth in the credit cycle. And as you get deeper into coming out of 2014, 13, we had a very clean bank book sheet. because we'd gone through the fire and charged off a bunch of different things, but the banks had very clean balance sheets. But as you get later in that cycle, you're digging deeper into lower credit scores, right? And when you have delinquencies, those show up on your credit score. When you have charge-offs, you see the same thing. See how the charge-offs came down to record lows. So basically what's happening is auto delinquencies and credit card delinquencies started falling and charge-offs started falling through the floor at historical levels. And on the surface, you may say that's incredible. But understand how the US credit system, credit scoring system works. If you miss a credit card payment or a car payment, you go 1 month past due or 2 months past due, then you go back to current, that hits your credit score. You get a delinquency demerit on your credit score. So you're going to have a 610, a 580, a 570, a 605 credit score. If you have a charge off, that's going to hammer your credit score and you're going to drop 75 points, right? So what happens when you flood everybody with money and then you basically said, hey, we're going to throw away out 300 years of contract law. You don't have to make your rent payments. You don't have to make your mortgage payments, and you don't have to make your student loan payments. Prudent borrowers will go pay down credit card and autos. So one of the things that was happening was we were repairing people's credit scores. So instead of getting delinquency demerits and charge-off demerits, they weren't having to make non-discretionary payments to all these other, mortgages, rent, student loans. They weren't having to make those. They could make their payments on their auto and their credit card. So part of what was happening when your delinquencies are going down and your charge-offs are going down is we're taking the entire risk curve and like a bell curve, and we're sliding everybody higher scores. So people that were 590s became 640s. People that were 605s became 670s. We had an inflation in credit scores. And then this was happening when they weren't lending, right? And then all of a sudden banks are like, well, geez, we got an extra $3 trillion and we don't want to buy any more securities. We better start lending. Oh, look, there's a bunch of really safe people with high credit scores that magically came out of nowhere. How did we never lend to them before? And they rushed in and they started to lend to those groups. So the delinquencies and the charge-offs now are snapping back at much, much higher levels than we've ever basically seen before. Well, not ever, but they're mirroring, if not exceeding, what we saw in 2008, 9, and 10 on the consumer side. There's also an impact. How do banks deal with this, right? And so part of it is loan modifications. And so I'm going to go ahead and share my screen. So what I'm trying to get to is as delinquencies were climbing for credit cards and charge-offs were starting to climb, they were climbing at levels that we basically, like I mentioned, we were starting to see in the last cycle. So there's credit card delinquencies, and notice how they're way higher. And the reason they're way higher than they were at 274, 273, you're talking 60 basis points higher. Are charge-offs higher? Oh yeah, charge-offs are 536 basis points versus 430, 100 basis points. So it's no surprise because this is all the fake consumer that we talked about. So how did banks deal with this? They just started lowering payments. And so what you're looking at here is a couple of things that are problematic. One, you see a big drop down from $1.8 billion, 1.82 to 633 million. You see this big drop right there. You'll see it go from 2% of their loan book to 70 basis points. That $1.2 billion did not disappear. It's still there. But after 4.5, 5 decades of reporting loan modifications one way, they changed the rules. And primarily, it's the Bank Policy Institute and FASB that changed the rules. The Bank Policy Institute, which is the largest banks, basically lobbied FASB. And I'm not sure why FASB would do this, but I'm old enough to remember there used to be no such thing as non-GAAP. When I went and got an MBA back in the early 90s, there was no non-GAAP. Non-GAAP hadn't been invented yet, right? So we know FASB has a somewhat checkered past of carrying water for publicly traded entities. But basically, what they did is they said, look, instead of reporting life to date loan modifications, and I view it as a Ferris wheel. And I know it sounds a little silly, but bear with me. You have this Ferris wheel of loan modifications. And what a loan modification is you can't make 2%. That's what your payment is on a credit card, a minimum of 2%. You can't make that. So what we'll do is we'll lower your payment to 1%. We'll lower it in half. But we're putting you on the TDR loan modification Ferris wheel. And you work your way around the Ferris wheel making payments. And so what ends up happening is as you work your way around making payments on the Ferris wheel, if you put more people on the Ferris wheel and you modify more loans, the Ferris wheel can only ever get bigger. So I did this at Wells. I managed a small business portfolio, part of their collection team on the back end, and I did a lot of modifications. These are unsecured lines of credit, basically upwards of $250,000. And that's back when money was a lot more than it is now. But basically, what we were doing is we were lowering people's payments. And so on the surface, it sounds very reasonable. Well, they made payments for 12 months. We should allow them off the Ferris wheel. Well, no, because the way it's set up is you don't magically come up with a dollar amount that you force upon the borrower. The borrower calls you and says, hey, I'm past due, I'm going to charge off, and I need some relief. And the bank says, well, how much can you pay? And then you negotiate back and forth. But essentially what happens is you lower it to a level that the borrower can pay. And so when they go around that Ferris wheel making 12 monthly payments, if that's to be expected, that's the point behind it. If they go back delinquent or they charge off when that time frame, actually the regulators would slap us. Our corporate risk management team in San Francisco would slap us. We would get in trouble. So it's not year one where you have issues, it's year two. So as you get deeper into a downward cycle, they're no longer able to make those payments month 15, month 18, month 21. So the Bank Policy Institute's not ignorant. They're very clever. They know exactly what they're doing. As in, if 27-year-old Bill Moreland would have wrote the rules the exact same way, which is, hey, if they make 12 consecutive payments, they can get off the Ferris wheel. We no longer have to report them. So when I showed you Discover and they were ramping up their modifications to about 2% of their book, and then it dropped from 1.8 billion to 600 billion, that 1.2 billion didn't disappear. It's still on their books. They're still making lowered payments. They just get off the Ferris wheel. You don't see it anymore. So what we've done is we've changed the reporting to hide the issues. And it's my understanding that not everybody in the regulatory world was a fan of this. So once they lobbied FASB to change the rule, the banks, Goldman Sachs, Bank of America, JP Morgan, they ain't stupid. They had passed a rule 5 or 6 years earlier, and I don't know the exact timing, but I believe it was a number of years ago, that said, hey, the regulators, the OCC, the Fed, and the FDIC can't have substantially different reporting than what FASB has. And so once we lobbied FASB to change their reporting, that was the key to unlock the regulatory reporting for a change. And it was a change for the worse. So when you see the numbers drop and then ramp right back up, and they're upwards of 5.5%, which is what Discover. So Discover had modified 5.5%. And we know some people were probably getting off the Ferris wheel during that climb. So it's probably even bigger. But if you add back what they had taken off the Ferris wheel, which was obvious, they're upwards of 7% of their loan book has been modified. Those are unheard of numbers. We've never, ever had levels that high.
Yeah, really interesting. Thanks for laying that out. And so what does this mean? Does this just mean that, we're going to see sort of a flattening of credit, as you said? There's sort of going to be a slow slow decrease of this as you mentioned, as people pay it off over a longer period of time? Do you think it could be a crash in like in sort of banks and the exposure they have? How do you see it sort of playing through the banking system?
Yeah, it's an excellent question. And so I think in terms of bell curves, right? I'm just a risk guy. So I always say that as a reference or a metaphor. And basically, on the continuum of does it work and no way in hell, right? I'm still very much of the opinion this doesn't work. And the reason for this is you're going to have a second wave come back. So when you lower someone's payments and so they changed the rules in 2023 Q1 and they got to clean up the books. So if you really don't understand the reporting and you start to say in 2024 or 2025, someone says, hey, you should look at loan modifications and you go do an analysis, you'd say, well, the numbers where we're at now versus a couple of years ago, hey, they look kind of the same. People don't, that's wrong. It's wrong. We wiped out a bunch of it. So if we were going to say, how does this play out? Or what's my prediction of playing it out is, hey, man, assuming we still continue to have melees in the US economic system, you're going to see a rebound within 1 to 2 years of that initial loan modification. So I don't think it's a surprise that Discover and Capital One merged. I would, not a betting man, but I would place a wager that if you knew what was going on behind the scenes, I think that was an arranged marriage. And you can look at how much provision they stopped taking. You can see how much dividends they started paying when they knew they were going to get bought out by Capital One. And then when Capital One bought them out, there was an excess $7.5 billion of provision, which is what you offset for reserves for future losses, that they had to take because Discover wasn't taking it. So in that instance, you're going to have mergers solve this problem. So one outcome of this is we maybe start to see a lot more mergers, because you can go take a look at Capital One stock and it's probably cranking, even though they took a huge, enormous provision, which is an expense, and took a negative quarter on income or a big impact to it. Basically, the market just shrugs it off. And so that's one way to hide these losses, is to merge these banks together and do a series of one-offs. Now, I would argue, I don't think that's going to work. I think Capital One's going to start having a bunch, because they're having issues on their portfolio. The consumer is falling apart in a lot of areas, both in auto and credit cards. The second thing is we don't have just one problem. So if you go back to 2016, Trump won, right? Version 1.0, fracking. We're going to frack, drill, baby, drill. And what happened was the price of oil went way down. And then OPEC did the same thing. They punished it, right? They produced a lot more to drive the frackers out. And what happens is everyone got worried because C&I loans incorporates loans in the oil patch, but we don't know oil loans in the call report, but we do know C&I. And sure enough, C&I delinquencies went through the roof. And so that was a gut punch, right? Banks started to have lots of problems on their balance sheets if they had exposure in the oil patch, Texas, Philadelphia, or Pennsylvania. But the problem is, or the benefit during that time frame is commercial real estate looked great. Consumer looked great. Multifamily looked great. Ag, farmland, all looked great. So the system could take a gut punch and try to deal with that loan problem in the C&I space and get past it. We don't have that luxury this time. We basically have rising delinquencies in every single portfolio. Some are at all-time highs, some are rivaling where we were at in 2008, 9, and 10, and some are getting near. So multifamily is a problem, ag and farmland's a problem, construction's a problem, resi's starting to rear its head. And that whole resi's a whole other animal because the government is so involved, and I would say in a bad way, with government guarantees and all these programs to make housing more affordable, and none of them make housing more affordable because they drive more people to buy houses, which drives up demand, and supply doesn't change as much as that same curve. But every portfolio we're looking at starts to fall apart at the same time because you have a cup of debt. whether you're a business or a consumer, you increase your ability to sustain debt to the level that you can pay it. The problem is you get to the point where you can no longer buy anything. And our economy is not going to like that, right? Policymakers don't want that. Policymakers want growth. We've got to have growth. Well, how do you get growth when everybody's tapped on debt? Well, I got a great idea. Don't make your student loan payments. So while everybody in our Christmas party or our neighborhood Christmas party a couple years ago, or friends and your text groups, everyone's arguing over people should make their pay. They took those loans, they should pay them. Well, universities are being crazy, and these people. It is not a political discussion whether or not people should pay their $1.7 trillion of student loans, and it's up $1 trillion in like a decade. Has nothing to do with whether or not you're Democrat or Republican or where you sit on that divide. It's economic. It's basically, if we don't have people paying their student loan, they can go buy more Nikes and more Apple products because their cup of debt gets lowered, right? What else helps lower your cup of debt? Hey, loan modifications. Let's just start lowering payments. And so that empties the cup of debt. And what do people do? Most people go back up and fill up their cup of debt. So we may get, and that's why you get this 12 to 18 month kind of honeymoon where, hey, looks like loan modifications work, but they fill their cup of debt back up. You're still in a longer melees of economic situation. What happens when jobs fall apart, right? And we're cratering, right? We're getting close. Everything's showing. You don't just fall off the cliff. It's a slow inversion. Things are getting better. They float, they invert, they slowly get worse. And we're on this path, right? We've inverted, and now we're multiple quarters into worsening issues. I believe it's going to continue to get worse. I believe delinquencies are going to keep getting worse across the board. And so at some point, the banks are going to start seeing a rebound of those prior loan modifications that they're going to have to deal with as a second wave. At the exact same time, you're seeing a worsening in the portfolio that hasn't been modified. So I'm less dogmatic that there's no way in the world this is going to work, but only marginally so, right? But what I've learned through 20 years of looking at the bank data is you can't underestimate the policymakers' ability to change the rules. So if you have problems and you can't deal with the problems, and the way of dealing with the problems is recognized and tracked, we just stop reporting. I don't know if that was a pleasant answer to the question.
Yeah, no, it's really interesting. I guess now we sort of have private credit as well, so you can actually take it off the balance sheets, I guess, at these banks. So they sell them probably at a loss, but then you can actually sort of shift the
Yeah,
issues to the shadow
yeah, and
banking.
that's
Well,
that. So I'll spare your viewers of watching me butcher the sharing again, but the same issues that we saw, and I may share one more screen with Bank of America, but the same issues that we saw that I showed with consumer on credit card are echoed in the auto loans. And I can show you Truist Financial is one of the largest lenders, but it's also Capital One and its ally. They're at levels of loan modifications that we've never seen before, right? And so we know that becomes, it's what I call a gateway drug. Once a bank steps across the threshold of saying, hey, I'm going to start doing some loan modifications. Why do they not want to do loan modifications? Well, historically, that hammers your Texas ratio. So now you see another side benefit of changing the rules is all of a sudden banks look safer on their Texas ratio. So you really have to understand how insidious that one little minor thing is. But all the issues that we've talked about with consumer are the same thing with basically commercial real estate. So I'm going to share my screen one more time, and I'm going to basically try to do it in a good way. That should be it. And basically what I'm going to do is bring up Bank of America's CRE portfolio, right? So this is basically Bank of America. They are the second, now third, but during that time frame, they were the second largest lender in commercial real estate. These are non-owner occupied. What is the distinction between non-owner occupied and owner occupied, which you'll see down here? Repayment stream. Is the loan being repaid from rent income? That's non-owner. Or is it be paying from business proceeds? Like Bankregdata takes a CRE loan. I pay the loan back from my business proceeds. So these are non-owner occupied CRE repayment streams coming. So if you look at this, you can see the atrocious basically increase from 290 million to 2.25 billion. You can see it go from 79 basis points to 5.8%, right? So the delinquencies, and I'm going to show over here the largest player in the space is Wells Fargo. Those look identical, right? Almost 10 times the number, 10 times the number, 0.65 to 6, 0.79 to 6. These are the two biggest lenders in the space. But if you look, it looks like it started to cap out. It looks like it started to cap out. And then you could almost say it is. Look how good the delinquencies are getting. So the story is, wow, NPLs are starting to dramatically come down. You can see that best in that percentage right there. This is all managed. This is, and by the way, here is the third largest lender in the space. And I could talk about this massive drop in a little bit because that's going to get into your private credit or NDFIs, non-depository financial institution loans. But notice how it's rebounding. Notice how it's reigniting. And so that's what I talked about a little bit is you can lower your payments, but if these people come back 12 to 18 months later, you're just going to see an increase in the delinquencies. So our 2-year charge-off rate on our loans at Wells Fargo, and I was the risk guy, that we were putting into the Ferris wheel of loan modifications was about 21, 22%. And did we rehabilitate some of those people? Yeah. So if we go out 2 years later, we rehabilitated about a third. So about a third of the people that would have normally charged off in that 2-year time frame, they didn't. They became performing. We were able to get them back in. Their businesses got back on good foot. But 2/3 of them still charged off. So you took your 2-year charge-off rate from 22%, 23% to about 16, 15%. You still had a rebounding issue. But let's go back. Here's Bank of America. Here is Wells Fargo. How did we basically accomplish this incredible management of delinquencies? We basically just kicked in massive amounts of loan modifications at the exact same time, right? So if we put these two guys together side by side, how is it that the NPLs were skyrocketing because the banks weren't doing any loan mods? And then all of a sudden the loan modifications start kicking in and you see a slowing, and then you see they go into overdrive and you basically see the numbers drop. Well, these are directly related. If I lower your payment from $25,000 a year to $17,000, $25,000 a month to $17,000 a month, guess what? You're going to not be delinquent anymore. You're no longer going to be missing your payments. You're going to go back in. So looking at this and saying that we've magically got much better portfolios, we don't. In order to get this drop, we had to do an enormous amount of loan modifications. Now let's basically pull up Bank of America. And we're going to look at Bank of America over here. You see the exact same, almost like they had the exact same phone call at the exact same time with the exact same people in charge. Now, notice how this percentage was upwards of 8.5%. Unprecedented. Almost 9% of their loan book. And in reality, it's well more than 9%. Because remember what I said about the Ferris wheel. In 2023 Q1, notice how $300 million of modifications disappeared. They didn't disappear. That's reporting. We just stopped reporting that 300. Then notice how the number is 3 quarters or 3 months, 6 months, 9 months, 12 months. Hey, what's happening? People are getting off the Ferris wheel. Notice how it builds up 3 months, 6 months, 9 months, 12 months. What happens? people are getting off the Ferris wheel. So this isn't 2.9 billion. You have to add that 300 million. Now you have to add that 400 million, which is 700 million. Now you have to add that 800 million. They're really sitting at $3.5 billion of loan modifications, and the percentage is likely over 10%. So when we say that delinquencies are getting better, they're not. It's reporting. It's fake. It's what I call a Potemkin village. We have managed this to the point where we fake the numbers enough that they start to look good. And if you live in the village, you don't really know any different. We can't even see the edge of the village anymore because there's been so many changes. But that doesn't fundamentally change the fact that we're smoke and mirrors what's happening. So that is one way that we've managed commercial real estate delinquencies. Another way is banks are basically loaning money to private equity, private credit people to buy the loans off their balance sheet. So you remember that big drop in JP Morgan Chase, $300 million, where their NPLs skyrocketed, dropped $300 million about a year ago. I happen to know through calls with people I know in the industry that JP Morgan Chase was shopping a $300 million loan to have someone to buy it off their balance sheet. And they were offering them 90 cents on the dollar. So all the private equity group had to do was put in 30 million, and JP Morgan Chase would lend them $270 million of NDFIs to buy the $300 million commercial real estate problem off their balance sheet. And so that looks like it's getting better. And they put it on their balance sheet as an NDFI, and it looks fantastic. So they reduced their problems and they increased their loan amounts. But I heard from two separate sources that two different parties turned that party down because we're not going to make money on this. We know that property is problematic. The value proposition is probably about a 40-50% haircut. And 2 years from now, that main tenant is leaving, or they're going to renegotiate at a much lower rent. And so they told JP Morgan Chase no. JP Morgan Chase apparently countered, and this is all secondhand, but what I heard was JP Morgan Chase offered 100 cents on the dollar. I don't even understand how that's legal, but what that means is they would give a third party. It could be you. It could be me. It could be anybody, really, because you don't have any skin in the game. Hey, Bill, here's 300 million bucks. Take this loan off my commercial real estate loan off my balance sheet, put it on your balance sheet. I've got the loan still on my book as JP Morgan, but it's no longer CRE and it's no longer non-performing. And by the way, that loan is non-recourse. So in 2 years, if that Bill's private equity group decides to throw that commercial real estate loan back over the wall and give it back to JP Morgan Chase, they have to take it. So I think what's happened is between loan modifications at unprecedented 10%, 11% of Bank of America's portfolio has been lowered on commercial real estate. And we're seeing note-on-note financing, which shows up as NDFIs. And then these NDFIs are these amorphous loans that banks make to other people for various things. And I've already explained what some of those are, which are just workarounds, right? They're just smoke and mirrors. But some of them are tricolor, right? Some of them are basically first brands. And I'm not saying they're all that way, but understand we have to find different people to lend to. And if you want more economic stimulus, and you don't want to lend to it in your branch, you'll lend to someone else. We'll all call it a great loan as an NDFI, and nobody nowhere really understands where that money is going and where it works its way through because there's no disclosure. There's no reporting. There's no regulatory data capture mechanism. There's nothing. It just goes out. So yeah, to your question, are NDFIs of that private equity? Some of them are that kind of stuff.
Yeah, it's super concerning. But it sounds like, as you're saying, that there's going to be continuation of delinquencies unless, and I guess that would only become a lot worse if, there's massive unemployment for recessionary reasons. Are you concerned that there could be sort of a similar, Washington Mutual or a Silicon Valley bank, like a large blow up, or do you think that that was
Yeah,
something
it's
that's
called
probably not what
Flagstar.
we're going to see? Yeah,
There already is
yeah,
one. So I've done a number of videos on Flagstar, and I'm happy at some other point to have a Flagstar only analysis to explain why. But we took three banks: New York Community Bank, Flagstar. Flagstar took over. Then they renamed the entity Flagstar. And then there was the signature whole crazy thing going on during 2023. So we threw that bank. So we put three banks together. But it's New York Community Bank that was the source problems. Flagstar's bankrupt by any normal, any way you look at it. They're burning capital. Steve Mnuchin put in $1 billion, and they burned through $900 million of that. But they're firing a ton of people. They're selling off as many loans and assets as they can, both seed corn and delinquencies. They're selling a ton of non-performing loans. But their non-performing loan rate continues to climb because it's pigs in the snake. So even though they're working through their issues, there's more pigs working through that snake. And it's not just multifamily rent stabilized. It's a lot of things in their portfolio. It's a lot of their different portfolios that are problematic for them. But magically, when this all started to show up, remember what I said about just changing reporting. So I started barking, and we knew that Silicon Valley Bank had problems, but I didn't say nothing during this time frame of 2022. It was obvious a year in advance. I didn't say anything because they wrote me a check, and the FDIC, who's a client, wrote me a check, and where they were getting some of their funding from, they're a client. They wrote us a check, and so it's easy to get captured, right? And it doesn't have to be anything nefarious. It's just like, you know what? I don't really want to irritate a bunch of people. They're putting food on my table. Maybe I shouldn't publicly say anything. Now, not this time around. Flagstar, New York Community Bank was a client too. They've since fired everybody that we have as our primary contact, so we lost that relationship. That doesn't mean I'm being bitter about it. Their numbers are their numbers. It's not an emotional or qualitative assessment. It's pretty analytical. It's pretty quantitative. They're burning capital. They're not making any money at all. But their numbers are magically starting to be less. They're losing less numbers. And so I'm going to go ahead and show it. I can't help myself. I'm going to go ahead and share basically the figures. And I'm just going to bring up basically Flagstar. So we can actually put some numbers to this. So this is the second entity. We'd have to go back further in time, but this was the entity in 2023 signature. And then there was one prior. So they put a couple of banks together. And at that point in time, basically, you're looking at, 6, 7, 8,000 employees. They got upwards in 23 Q4 with the mortgage banking stuff. The number climbed through the roof. We're now down to 5,500. So we fired 3,200 employees. Notice how the loans and assets have dropped 23 billion and basically 20 billion, 23 billion on that. So they're shrinking the balance sheet dramatically. Well, what's happening with Tier 1 capital? They're going to say we're more capitalized than we've ever been. And technically, it's correct, but it's fake. And so one thing to note is if a U.S. bank ever gets a Tier 1 capital with a 10 handle, they always raise capital. I am convinced that there is a threshold where they're told you have to start selling assets or you have to do a capital raise. You can look at way too many banks doing it. Key, Truist did the exact same thing. But notice where we get this basically big jump in the money coming in. And then we see Mnuchin's number jump in there. But during this time frame of a peak, notice how we burned through $850, $900 million of that $1 billion of capital. But they can report they're more capitalized than they've ever been. Meanwhile, they're also going to report, if we look at their pre-tax net operating income, that the numbers are atrocious, but we're slowly starting to get better. We're going to start making money. But the reason their capital is getting burned is because they're having to take money out of retained earnings, which is tier one capital, part of tier one capital. So this is exactly why the number's coming down so much. But meanwhile, if you basically come over and you look at NPLs, the numbers are huge. And you see massive NPL rates. So even though they're taking huge charge-offs and the numbers start, so there's the story. Charge-offs are coming down. Income is getting a little better. We're more capitalized than we've ever been. But what happened to that $340 million of loan modifications? We've never really gotten a good answer of what happened there. But here's the proof in the pudding. The reason they're able to show increasing pre-tax net operating income is that they are not taking any provision. Provision, notice how these are for loan loss leases. So this is allowance. This is allowance for loan and loss leases. It's a big giant bucket of reserves. At the bottom of the bucket is a hole, which is charge-offs. You fill the bucket with provision. So they're able to show great earnings by just not showing any provision. We're talking massively low levels, 17 basis points. Come down nationally, they're in the bottom half, 50 cents. So not horrible, but the problem is you come in here and you look at how much coverage ratio they have. So 3 years ago, they had $3.38 of reserves for every dollar of adjusted NPLs. Adjusted means you take out any government guarantees. So this is what hits their book. This is what hit their income statement. Then the number drops to 160, 150, 170. Then it drops to 65, then 40. We're at 33 basis points. The reason they've been able to basically show massively improving earning numbers is because they're basically not taking any provision for losses. So when you said, what is there going to be a WAMU? Yeah, it's Flagstar. But what happened was about a year ago, the FDIC reports a troubled bank list. And it's basically, they don't report the list, but it's kind of Texas ratio and tier one capital. But I think it's a simplified kind of model of that. But that's my own estimate. That's not anything official. But what they used to report, and for 4 decades, they reported it this way, is we have 58 banks for $9 billion on the troubled bank list. And when times get better, that gets smaller. Then all of a sudden, about a year ago, they said, hey, you know what? We're no longer going to report assets. So basically, by hiding that number, what that told me was that they had a $100 billion bank. So if you went from 7 billion of troubled banks, 7 billion of troubled banks, 7 billion to 107 billion, if they had to report it that way, everybody would go out and look at how many banks are $100 billion, look to see which one it is and say, oh, Flagstar's on the troubled bank list. But they're not going to allow this to happen. They're not, because it's about the illusion, right? It's about the illusion of safety and security. So what's going to happen is basically they are going to essentially what's going to happen is it will get better. And then second quarter of 2026, JP Morgan Chase will buy it and it'll be a success.
Yeah, well, it seems to be what always happens. They sort of dump it on JPM. But Bill, thanks so much for your time today. We sort of covered so many different aspects, and I really appreciate you going into the nitty gritty of all the different banks, the balance sheets, and yeah, what we've been experiencing. And yeah, it definitely doesn't seem like it's going to go too well in the future. But my last question is, what is one message you want people to take away from our conversation?
So the one thing I should note is everything that I've kind of laid out is primarily a big bank issue. The U.S. community bank segment is actually quite strong. There's a lot of talk about their exposure to commercial real estate, but that's because they don't have any trading exposure, which the big banks do, right? That's because they're not buying as much treasuries, which the biggest banks do, right? And that's kind of the devil's bargain we talked about a little bit earlier. But the commercial real estate delinquencies for the community bank sub $50 billion segment, yeah, there's always going to be a bank here and there, but the delinquencies are much, much lower. And it's not because they're modifying a ton of debt. If you look at the delinquency rates in the community bank segment, they're pretty low relative. So mostly what we're having right now is very much a large bank problem in the United States, which also goes a long way to explaining why they're changing the rules. Where I think we get problematic is if we have a prolonged melees or we basically start to have a loss in jobs. And what will end up happening is all those loan modifications, all those off balance sheet NDFIs, all those weird NDFIs, those private equity lending that nobody knows anything about. You're going to continue to see those blow up, but you're also going to start to see a ripple through effect. But primarily, I think most of the community banks in the United States are extremely healthy. It's the largest banks you have to watch, but understand never underestimate the capacity to avoid pain. So if we have to change rules on reporting, they will. I don't think that changes the dynamic of whether or not the banks are still going to be problems, but it makes it much more difficult and it gives them a longer time frame. I think you're going to hear a lot of reporting about how things are better, and I think there's a better than even chance that you're going to start seeing the delinquencies rebound in 2026 for the larger banks. The market may or may not care, but I think we are going to see a rebound in delinquency rates for a lot of the larger banks in the upcoming year.
Yeah, great, really interesting. So thanks again. If anyone wanted to find out more about your work and what you do, where would the best place for that be?
Yeah, I mean, just go to Bankregdata and you can reach out to me. Our phone number is down there. Obviously, I'm more than willing to talk ad nauseum on the subject. But yeah, there's a lot of cool stuff here. There are a lot of good macro things as well, right? Understanding what's going on in the industry, you can just add up all the data, and you saw how I showed that from an industry level. So if you have any questions, please reach out and give me a call. I'm more than happy to do anything I can to help.
Yeah, great. I'll put it in the description below, but thanks again for your time.
Thank you, Anthony. I appreciate the opportunity.